Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today I'm here with Gerry Reihsen of Coasis Coalition. Thank you for joining us, Gerry.
Hall, it's a pleasure to be joining you on this call.
Great. So what were you doing before you started this business you're at now?
So foundationally, I'm a corporate securities attorney. I did that as outside counsel for 15 years, 10 of which with a large firm called Gibson, Dunn & Crutcher. But at the end of that period of time, I got very antsy to be entrepreneurial, ended up starting with two other professionals from Nortel, a telecom software company in the late 90s. That matriculated for a couple of years and we sold it. And then I co-founded a real estate investment fund platform called Behringer Harvard. And that built up to about $12 billion in real estate assets under management across the world until we got slapped down a bit. We continued on beyond the Great Recession. And so that's pretty much the background. Now I'm building a new company, and that's why I think you're talking to me.
Well, great. So tell us more about the new company that you're building. When did you start it and how did it start?
So I literally was starting a different company. I had generated a concept for a machine learning, artificial intelligence concept. And I was creating the deck to attract investors and others. And in my decks, I always include a slide or two on the tax effects because especially with early stage companies, you're going to have some tax benefits, whether under Section 1202. That includes up to at least $10 million in gains or otherwise. And I thought to myself, I better go see, it's been 15 years since I started my last company, if there's anything else out there that I can make my investors aware of that is advantage to them. And I discovered the Opportunity Zone statute. This would have been in maybe April or March of last year. And it blew my mind. All I had to do was structure a company with a qualified opportunity zone fund over the top of it, which can be anything you want, be a holding company, and put it in an opportunity zone. And we had an opportunity zone halfway between where me and my partner live. And so I started to go down the path with that. And it suddenly occurred to me, wait a minute, all of my background lends itself to creating a company to provide support services and products to the opportunity zone ecosystem. And that I can put that other company underneath that ecosystem later. And the space really needs support because it's a redo of the entire investment and financial system and entrepreneurial and business system with a compliance overlay. So my partner and I started to create a company called Coasis Coalition with multiple verticals, although I like to call them horizontals, because they kind of layer one on top as opposed to side by side. So that's how I got to this point.
Great. So tell us more about the Opportunity Zone. Why is it there? How did it come about? And who is it for?
So the Opportunity Zone Tax Incentive Program it was actually created substantially by a fellow by the name of Sean Parker, the famous Silicon Valley investor. And his idea was, look, all of us in Silicon Valley and elsewhere have all these gains, and we care about the world and want to provide a social benefit. Why don't we find a way to be incented to take those gains and invest them in underserved and overlooked communities? And so that actually matriculated for a few years under the Obama administration. And frankly, Obama administration professionals pulled the entire effort of creating that statute with some nonpartisan other side of the aisle help by persons who also believed in it. The statute is thought to be a Trump concept, but it's really not. It was floated a few times during the Obama administration. But what happened was when the House negotiated the tax reform bill that Trump created, when the Senate considered it, the statute skinnied down quite a bit from what had been out there, was introduced into the Senate version without much debate, but in a nonpartisan way. Cory Booker and Tim Scott, a Democrat and Republican, were the big proponents of it. And when the reconciled bill got voted on, it stayed, and then Trump discovered it. So those who say it's a Trump tax budget, whatever they might say, don't really understand the background of it. Anyway, the point of it is this. For those of us who are taxpayers, this doesn't apply to pension funds or foundations or nonprofits, but it applies to people like insurance companies, high net worth individuals, family offices, the various companies that pay taxes. To the extent that we realize any capital gains, we can take those capital gains and invest them into this. I'll describe the ecosystem in a second. This opportunity zone ecosystem, which then invests into up to 8,766, as I recall, low-income communities based upon the 2010 census and statistics. In so doing, that investor, the top-line investor, gets a set of tax incentives. One is they defer tax on those capital gains for up to 7 years. Two is they reduce the taxable amount of those gains by up to 15%. And three, they can dispose of that investment if they hold longer than 10 years in a manner that is tax-free. In other words, the way it works is that their basis is written up to fair market value when they sell their investment after 10 years. But if you were donating it, I guess you'd do a valuation and get that much valuation of your donation. So that's how it works at the investor level. Very simple. It's also simple to describe at the lower level, but in practice, there's a lot of expertise required to make sure that you are compliant and do things without getting into trouble.
So tell us more about the compliance side of it. It sounds like a great opportunity, but tell us, what are the challenges in going for an opportunity zone designation?
So there are regulatory and practical challenges. The regulatory system is that the investor must invest in something called a Qualified Opportunity Zone Fund, or QOF. And that fund doesn't have to be a traditional fund. I mean, you and I, when I was setting up for the business I mentioned, my partner and I were just going to sell some stock and invest down in ourselves through a company we then make a filing for and call it a Qualified Opportunity Fund. And then our investment would have been tax-free. Our company would have been tax-free if we sold it 10 years later. And all the other investors could come into that ecosystem as well. Anyway, the investors invest in an Opportunity Zone fund, and that fund has to keep 90% of its assets. That's the current rule. The IRS is looking at that. 90% of its assets in Qualified Opportunity Zone property. Now, Qualified Opportunity Zone property is real estate developments or tangible business assets or a company that owns real estate developments or tangible business assets. So that's how you can put something like my operating company I mentioned under this system. There's a bunch of details as to how to do that. If you're a business, which I think has right up to date, almost all of the activity has been in multifamily real estate developments, some other real estate developments, and very little in companies, because the rules, believe it or not, more than 2 years later, are not final yet. But you can imagine how complex businesses are, and so how complex the rules get outside of the real estate side. So you have to keep 70% of your tangible owned or leased assets as a business in a zone, and you have to have 50% or more of your gross receipts, your gross income for the operating zone business attributable to the zone. But your revenue can be worldwide. They just have to be attributable to the activities you're having in the zone. There's some rules around that, which are probably too much to get into here.
So tell us more about the product and services you provide around this area of opportunity economic zone development. What exactly do you guys do for them?
Well, so as I mentioned, the horizontals that I have are founded on the bottom. The foundational horizontal is both twice annual major national and very transactional conferences. Our next one in Monterey, California, February 13 and 14. And the URL is Coasis, OZCon for conferences.com. But we do those conferences both for education, but mostly to assist in parties coming together. That is, persons that are investors with capital gains and persons that are seeking capital, whether through a fund or for a business or for a real estate development. Because the nature of this space is the capital is what you might call perishable. because, and don't think I mentioned this before, you only have 180 days from realizing that capital gain to get it into an opportunity zone investment. And back at Barringer Harvard, my fund company, we had a similar syndication concept around selling tenant common interest and Delaware statutory trust interest under Section 1031, which also has a 180-day period where you have to, if you sell a real estate asset, you can invest in another real estate asset and move your basis over if you do so within 180 days. And it was really valuable to set up transactional conferences where people would pitch, have curated one-on-one small group meetings. I co-founded a company a trade organization called TICA, which is now called ADISA, which did that. So that's our foundational horizontal. And the reason it's foundational is it forces us to be always at the forefront of the law, the lore, the transactional dynamics, the people. It keeps us right there in the thick of things. We do things like write comment letters to the IRS. We write lots of articles in any event. So that's the foundational piece. Beyond that, we are currently developing software for the space. It's a little bit confidential, but 2 different types of software. We're developing a very proprietary, it won't be proprietary once it's out, but a co-working concept, which is very niche-y to avoid partly all the vicissitudes of co-working business. But that is really important to have for the qualified opportunity zone businesses. And we do a good bit of consulting. I maintain a boutique corporate securities law firm and non-law consulting to folks who are trying to take advantage of this tax incentive.
So that sounds great. I understand you have a conference coming up as well. Can you tell us more about that?
Yeah, as I mentioned, it's in Monterey, California, which is absolutely gorgeous. It's like a mini San Francisco. It's even got its own Fisherman's Wharf. It's got its own nearby winery valley. John Steinbeck wrote about its Cannery Row. It's really quite an amazing place, and not nearly as large and much more pleasant than San Francisco. And it's February 13 and 14, which is Valentine's Day, and also the Thursday and Friday before the President's Day weekend. So we anticipate a lot of folks staying over for 5 days and enjoying the wineries and all the other things that area has to offer. We have a special rate at the Marriott there of only $219 a night through that entire time. We didn't just do it through the conference, which is about $200 to $150 off their normal rate. We got American Airlines to get us 7% off their travel airfares. So you were really looking to make this the preeminent transactional event in the space. And to do it, we'd like to do it in Monterey every year about that time. Our subsequent conference is going to be in Frisco, Texas. That's in September of next year. And that fall conference will tend to move around cities, but I'd like to make Monterey our kind of traditional space every early part of the year.
That sounds great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, the reality is twofold with regard to the opportunity zone space. I actually view it as an amazing opportunity to put people to get back together who have grown apart. With the massive growth of our cities, you've seen people resegregate themselves. And the opportunity zone space, much like a high school I started here in Dallas and was originally founded in Chicago, Cristo Rey High School, which, by the way, we sponsor with a portion of our proceeds go to Cristo Rey schools, bring together folks who have grown apart to a certain extent, which I think has huge value, especially in the face of what seems to be disintegrating kind of factionalism. Number one. Number two, I think that every business ought to be looking at how to leverage the opportunity zone space. If you have an existing business, you should be looking at how to put a growing subsidiary in this opportunity zone ecosystem. If you're a business that's starting out, you should be looking at it. And there's just so much creativity that's available. Everybody should be considering the opportunity zone space.
Well, that's great. Well, thank you so much for taking time. How best for listeners to get back in touch with you?
So I think you'll post my email, which is fine, on your links at the bottom. Coasis Coalition.com is our company website. CoasisOZCon.com is our next super conference website. And I'm on LinkedIn. And so I love talking to folks. Love hearing what their new ideas are. So they should feel free.
Great. We'll put those in the show notes. Thank you for joining us today and hope to have you back for a follow-up soon.
Very good. Thank you all.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.